TA with MK. It's TA with MK.
What is a moving average?
You know, I reckon it's the amount of times I've moved, right?
Ahaha, you're not wrong. But more specifically, what is a moving average as it relates to crypto and trading stocks?
Ah, you tricky son of a gun. Well, then I reckon it's the amount of times that an investor has moved, right?
Not quite. What it is the average price of a stock over a given or specified period of time, and traders use these to determine whether a stock is currently bullish or bearish. In this video, we're going to discuss the most commonly used moving averages as it relates to trading crypto. We're going to also show you how to set them up on a chart in TradingView and what settings to use. And then we're going to finish off by discussing a few concepts as it relates to moving averages and how they can help give you an edge when trading crypto. If you're liking the content, please remember to like and subscribe. Thank you for joining me on TA with MK. My name is McKay, and let's go. All right, so wasting no time, we're over here on TradingView.com, and under search markets, we're going to type in BTC USDT. I'm going to click this Binance chart on the top, let that load up. I'm going to double click out in the empty space to hide my indicators. I'm going to hide this as well. Down here on the bottom left where there's the trash can, I'm going to click that just to make sure I have a clean, fresh chart. Then we're going to compress it a little bit so we can see a little more price action. Now we're going to head up here to the top left where it says indicators. Go ahead and click that. Now the indicator that I'm going to have you add is the one that I use. And so it'll just be the easiest one for me to teach on or show how it works and whatnot. Now at the end of the video, I will show you some other moving averages that other traders use and put higher emphasis on. These are just the ones that I was taught to use and they're the ones that I put emphasis on. So the one that I find to be the easiest for this is you're going to go ahead and type in CBC space 5MA. This one that comes up under community scripts that says CBC 5MA DRS. Go ahead and click the favorite star next to it and then click to add it to your chart. Go ahead and click this X. Now up here on the top left under this drop down box, if you click this, you should be able to now see this CBC 5MA in here. We're going to go ahead and go to the settings. I want you to go over here where it says style. Well, first under inputs, make sure that this all came up correctly. 21, 50, 80, 100, and 200. And then under style, go ahead and pause and just make sure that all of your colors and stuff all match this and that nothing has been changed or differs from this. Then go ahead and click OK. Now, two things I want to take note of before we move forward is that I am using what's called the SMA, which stands for Simple Moving Average. There are two types of moving averages most commonly used in trading, and they are known as the simple or the exponential. And the main difference between the two is that exponential puts a little bit more weight or heavier emphasis on recent price action. So they're very similar, but that is the difference. And at the end, on the two most common moving averages, which I believe to be the 50 and the 200, I will show you how it's not a bad idea to have both the simple 50 and the exponential 50, as well as the simple and exponential 200. Now we're back over here on the daily chart for Bitcoin. I'm going to click my paintbrush here real quick, and I'm going to show you what each one of these moving averages are and what they represent. So this white one you can see here moving along, this is the 21 simple moving average. So it just means that it's the average price over the last 21 printed daily candles. This red one below that is the 50-day moving average. This purplish one is the 80-day moving average. The blue is the 100, and the yellow is the 200. And while the concept should be simple, I want to briefly explain that these moving averages rarely stay in the correct order. And the reason is that they each represent a different amount of days, right? So something like the white 21-day moving average takes less day of price fluctuation to influence its curve because it's taking into account less days of data. So right back here when Bitcoin in late July started to pump, you could see that this 21-day moving average started to react quickly. Whereas the 200-day, since it takes more days to influence it, it had been in such a high upward trajectory for so long that when Bitcoin was in this downtrend, all it did to the 200 was slowly make it plane or level out, right? Now, the important thing to understand with moving averages is just like any other types of support or resistance, you don't want to trade solely based on them. You want to use them in confluence with other ideas. What I mean by that is we know from previous videos that I've shown that price levels are obviously probably the most significant forms of support and resistance. We know that patterns or trend lines specifically act as support or resistance. And we're going to show you in this video how moving averages can act as support or resistance. Now, to demonstrate a bit of what I'm talking about, I went ahead and cleaned the chart up a bit. We're still on a Binance daily chart for Bitcoin. We're going to focus on price action from 2017, the blow off top in December of 2017 through about November of 2018. It's important to note that there's a plethora of reasons that a trader would decide to buy or sell a crypto or a stock, whether that's horizontal lines of support and resistance, whether that's patterns or trend lines, or in this case of this video, that could be moving averages. It's also important to note that a lot of traders use trading bots that are programmed to buy on specific things like the moving averages. So we're going to focus on the 200 right here and show you how, in confluence with other reasons, you can use it to know when it's a good time to potentially buy or sell. Now, I'm first going to go over here to my trading panel on the right, and I'm going to go over here where I've added some lines of support and resistance, as well as some zones of support and resistance. Now, if you haven't watched my video on support and resistance for price levels, I will link it in the description. It goes over the significance of finding important price levels where price is interacted with the most, and also I go over in that video how support and resistance as far as price levels go are more of a zone in most cases than an actual exact price. Okay, go ahead and get these zones added as well, and then close that panel up. And I just wanted to show these. So these two zones I've added that I've indicated with these blue boxes. If you could see, I'll use the paintbrush, that this top blue zone, I've shown that price at the bottom side of this bounced once, twice, 3 times around there. And then if you go to the top of the zone, you know, you've also had it bounce there. You've had it act as resistance once, twice, and 3 times. So this whole kind of area is a zone. And then just below that as well, you've got another area where price bounced at the bottom of this zone. On the outside of here, it bounced here, here. Once it flipped over here, it acted as resistance. The top of it here acted as resistance. The bottom of it here acted as resistance. So it's definitely another zone of importance where price is interacted with on multiple occasions. So now, as indicated on this chart, we have 2 different things acting as overhead resistance for price action. We have this trend line that started to develop where it was getting rejected. Then we have levels of price action. So like right here, it got rejected, came all the way down. Then as it came back up, it met this trend line at the same time that it was meeting the top of this zone of resistance. So then that rejected it, you know, and then again right here, this was the bottom of that zone, but also the bottom or just below the trend line. So now you had multiple reasons or confluence as to why price was getting rejected. And now just for the icing on the cake, we're going to open back up this panel and I'm going to turn back on the moving averages. Now I did turn off all of the moving averages except the 200 since that's the only one I want to focus on right here. But now we can see that as price action, you know, got rejected up here at the trend line, came back down. Now right here, it was being met with the top of this blue box of resistance at the same time as the trend line, which that wasn't even a trend line yet at that point. It only had 1, 2, I mean, it was a trend line, but not a valid one that too many traders would have been trading off of. But it was met with the 200 moving average over top as resistance. So there was a lot of sellers waiting there, and that caused the rejection that became the 1, 2, third point of the trend line. Comes all the way down right here at the top of this blue box. You have that overhead resistance. You have the 200 again, and now that created the 4th touch for the trend line. So now you can kind of see how with confluence there was multiple reasons, especially by this 4th time, that there was going to be a lot of sellers stacked there. You had a trend line acting as resistance, you had a price level as overhead resistance, and you had the 200 moving average as overhead resistance. Holy moly, Benjamin! Price levels, trend lines, moving averages. What came first? The chicken or the egg? Doesn't matter. All that matters is omelets are good. To finish this video up, there are 3 concepts that relate to moving averages that I'd like to go over real quick. The first one being what's known as a squeeze play, and that's just whenever all the moving averages get real squeezed together in a confined spot, almost looking like one moving average.
Phenomenal cosmic powers!
And price action is above or below. Number 2 would be whenever all of the moving averages are in order and price action is above or below. And then number 3 would be the golden cross and the death cross as it relates to the 50 moving average and the 200 moving average. Let's go. To demonstrate what a squeeze play is, I have brought up a 4-hour chart for Bitcoin. And we've got price action between late August of 2020 through October of 2020, so a couple of months. Now you can see that it lost the 200 and all of its moving averages here early September of 2020 and plummeted clear down here. It slowly regained to the 21. Then it regained to the 21 and the 50, shot up for a bit. 200 acted as resistance right here, so it went back down, lost all the moving averages again. But then right here, so back here you can see they were spread way out like a big fan, right? But then over here they started to compress and come together. And you know when they're compressing and coming together that price is going to potentially move quickly or explode in one direction or the other. And the odds are going to favor whatever direction price action is. Is it on top or below the moving averages? In this case, it was kind of stuck in between them all, but it had tested the 200 twice right here as support, right as all the moving averages were squeezing together. And then look what happened. Boom, big explosion up. Then it rode the 21. Boom, big explosion up. And if we kind of zoom out to look, price action went on quite a run before it ever even retested the 200. Now that same price action brings me to the next concept, which is that it is bullish or bearish if the moving averages are all in order. On this exact example, once it had the price squeeze here, or the MA squeeze play, it broke up. Then it started to use the 21 and the 50 as support. So as long as price action is above the majority or especially all of the moving averages and they're in order, and what I mean by order is that the 21 is above the 50, 50 is above the 80, 80 above the 100, and 100 above the 200, they're all in order, and price action is on top of them all, that is when you will see price action be the most bullish. Or the reverse of that, if all of them are in order and above price action, that is when it will be the most bearish. And then that brings us to our last concept, which is the golden cross or death cross. And that is any time that the 50 is interacting with the 200. Now, an example of a death cross would be any time the 50, or in my case the red moving average, as indicated here, is crossing below the 200, which is the yellow. This is making an X because they're crossing. The 50 is coming below, and as you can see, that led to a lot of downward price action. On the flip side of that, anytime that the two are crossing with the 50 coming up and over the 200, that is known as the golden cross. This is bullish, and you can see it tends to lead to a lot of positive price action, especially on these higher time frames like the daily. And to finish up, as promised, we have our 50 and 200 simple versus exponential moving averages. Again, the exponential just puts more weight on recent price action. The thicker lines are what I typically use, which is the simple moving averages, and then the thinner lines are the exponential on this chart. Now, when it's the 50 and the 200, those are the two moving averages that I think are the most commonly used in trading, especially for mid or longer term holders. And they are the two that I like to use both for, because as you can see, they get different signals, especially the 200. They can spread apart decently far. Now the red, they tended to be support at the same spots, resistance at the same spot, because they don't get very far apart, just less days, so not as much time for them to differ. But in the case of the exponential versus simple 200, you can get some pretty big differences here, right? So right here, my thicker one, which is what I usually use, the 200 simple, acted as resistance here, but then the 200 exponential acted as resistance here, right? On the flip side of that, when Bitcoin broke out last end of July, early August, and it was retesting down here, obviously that was a price level of support, but it was also the 200 exponential moving average. But then up here, it was the simple 200 moving average. So having both on just gives you a little bit more of an edge, because there's going to be a school of traders that uses one, a school of traders that uses the other, and then there's going to be the few of us that are smart and use both. Now, I did mention earlier in the video that I would end by letting you know some other moving averages that are, sworn by or used by other traders. To be honest with you, I kind of spoke ahead of time, just assumed there'd be other moving averages, and I'm sure there are. But I couldn't find any one moving average that was used so often that it was worth sharing with you guys. Don't want to send you down some wrong path. To be honest with you, most people use the 20. I use the 21, but I mean, that's one day, so they're basically the same. And the 50 and the 200 are literally the most common. So rest assured, I think I set you on the right path. The main difference is whether or not you want to use simple or exponential, but I would recommend on the 50 and 200 using both. And that was TA with MK. Today we talked about moving averages. Hope you learned something. Remember to like and subscribe if you're enjoying the content. We'll see you next time. It's TA.